Good day. Welcome to another section of AE accounting tutorials. We are beginning a new series on accounting for leases, that is under Ifrs 16 leases. We are going to look at the accounting arrangement for leases by the lessee under the Ifrs 16 criteria. So we are going to take so many questions and try to solve to enhance our understanding. But before we do so, I want to use this video to inform you about the basic knowledge you need to understand as far as Ifrs 16 leases is concerned. Before I introduce you to the basic concepts of the Ifrs 16 leases, I will entreat you to subscribe to this channel, turn on the notification bell so that anytime I upload new videos on this topic, you'll get notified. Is that okay? A lease is an arrangement whereby the lessor conveys land, building, properties, services, etc. to the lessee in return for payment for the right of use assets for a specified period of time. Is that okay? So basically that is the meaning of a lease. So in a lease agreement or lease contract, there are two parties involved, okay? That is the lessor and the lessee, okay? So we have the lessor and we have the lessee, okay? So the lessor is the very person who legally owns the assets, okay? So legally owned the assets, okay? And the lessee is the very person or the entity who uses the assets or uses the assets. Is that okay? So you can imagine that when you don't have enough funds to acquire a property, is that okay? Let's say you are into a manufacturing firm and you need a very huge plant for your project, but you don't have enough money to acquire that. You have to lease the plant for your project, okay? So that can be done in an agreement. That is a lease agreement between the lessor and the lessee. So the very person who owns the plant, it is the lessor, and you, the very person whom the asset is going to be leased to, is the lessee. Is that okay? And because you are going to use the assets, you have to make payment to the lessor, okay? So you make payment. So that payment you make what we call the rental payment. And you may lease the item for, let's say, about 5 good years, okay? Because you are going to lease it for a number of period, the payment will be done periodically, okay? So the payment will be based periodically, okay? So because the payment is going to be done periodically, the agreement can be made in such a way that the payment will be made either in arrears or in advance, okay? So one, the payment can be made advance. Payment can be made in advance. That is at the beginning of the financial year, okay? So at the start of the financial year, okay? So at the start of the financial year, that is one model. That is where the payment is made in advance, okay? Another agreement can be made where payments will be made in arrears. That is, so this will be most of payment. Good. So in arrears, that is where payment is being made at the close of the period, at the close of the financial year. So at the close of the financial year, that is at the end of the financial year. So it is an agreement that is going to be exist between both the lessee and the lessor. Either the payment to be made at the beginning of the year or at the end of the year, and each accounting arrangement is different, okay? So we will be taking questions and try to enhance our understanding on it. But before then, I want you to understand the basic concepts when we talk of Ifrs 16 leases. Before the introduction of IFRS 16 model, we have an old model that it is normally used to account for leases. That is IAS 17. Okay, so IAS 17. So this standard was basically used initially to account for leases. Under this model, it is the responsibility of the lessee to classify the lease into an operating lease or finance lease. So here, the lessee has the right to classify the lease as an operating lease, or a finance lease. Okay, so under this criteria, it is the responsibility of the lessee to classify the lease as either an operating lease or finance lease. Under operating lease, all the risks and rewards still remain with the lessor. Is that okay? That is where ownership still remain with the lessor. Okay, so for operating lease, it is treated as an expense in the statement of profits or loss. Okay, so that is how we describe an operating lease. Okay, for operating lease, there are those assets that it has low value, okay, or short-term leases. When I talk of short-term leases, that is where the lease is less than 12 months or 1 financial year, and below. That is 12 months and below. Is that clear? Or the asset is of low value. We classify all those leases under an operating lease. Okay, so it is the responsibility of the lessee to do that. Okay, and then the finance lease, it is a lease where all the risks and rewards are transferred to the lessee. Okay, such leases are of high value and of long-term leases. Okay, and this finance lease, it is the lease liability is actually recognized in the statement of financial position. One of the reasons why the new model, which is IFRS 16, was introduced is that the lessees, they normally classified most of the leases under operating lease. Okay, and then they treat it as an expense in the statement of profit and loss, and no liability or the asset value is not recognized in the final statement of financial position. Okay, so because of this reason, a new model has been brought in to take care of all these circumstances. The main objective of the introduction of the new model, which is the IFRS 16, is that it set out the principle for recognition, measurement, presentation, and disclosure of leases. Under the IFRS 16 leases, okay, it is the responsibility of the lessee to recognize the right of use assets and the lease liability. Okay, that is the initial recognition. Okay, so for the lessee, that is initial recognition. At initial recognition, that is at the commencement date, okay. One, the lessee has it a duty to recognize the right of use assets. So the right of use assets. Okay, and two, the lease liability. So basically, these are the two things the lessee has to do at the initial recognition stage. That is at the commencement date, the lessee has to recognize the right of use assets and the lease liability. So we are going to look at the components of the right of use asset. Okay, so the cost of the right of use assets. Okay, so the first thing the lessee has to recognize under the right of use asset is the lease liability. Okay, so the lease liability. Okay, he has to recognize the lease liability. Okay, and 2, any payment made at or before the commencement date. Okay, the lessee has to recognize that. And if there is any lease incentive, so if there is any lease incentive, it has to be subtracted. Is that okay? And 4, if there is any initial direct cost, incurred by the lessee, it has to be recognized. Okay, and if there is any estimated dismantling cost, okay, that is incurred by the lessee, it has to be added. Okay, so the summation of this is going to give us the right of use asset. Remember that with the lease liability, that is the amount of the initial measurement of the lease liability. Okay, that is what is going to be recognized under the right of use asset. Okay, and if there is any payment that is being made at or before the commencement date, okay, it should be included in the right of use asset. And if the lessor gives out incentives to the lessee during the lease contract, it's supposed to be taken off from the right of use asset. And if there is any initial direct cost incurred by the lessee in an attempt to arrange the lease agreement, it's supposed to be added to the right of use asset. And if there is any estimated dismantling cost incurred by the lessee on the asset involved, it's supposed to be also added to the right of use asset. Okay, so now let's look at the components of the lease liability itself. So let's look at the lease liability. Okay, the lease liability itself. Okay, but remember that the component of the right of use asset and that of the lease liability is recognized under the initial recognition. Okay, at the initial stage. Okay, so I told you at the initial stage or the initial recognition, the lessee has to recognize the right of use assets and the lease liability. So that is what we are doing at the commencement date. That is at the initial recognition. Okay, so the lease liability may include fixed payments. Okay, fixed payment. So if there is a fixed payment that's supposed to be made by the lessee to the lessor periodically, is supposed to be part of the lease liability. Okay, I told you when you lease an item from a lessor, there is a rental payment that's supposed to be made to the lessor annually. So maybe every year you pay 1,000, every year 1,000, and that 1,000 is what we call the fixed payment. Is that okay? So after the fixed payment, we consider lease incentive. Okay. Okay. So if there is any lease incentive that is given by the lessor or that is given by the lessor to the lessee, it has to be taken out from the lease liability. If there is any lease incentive, it's supposed to be taken out. Okay. And if there is any variable payment, okay, is supposed to be added. Okay, is that clear? So this variable payment, maybe the fixed payment is supposed to be 1,000 every year, and because of time value of money purposes, there has been an agreement that at the end of every year, the lessee should add another 200. Okay, meaning that at the end of every year you'll be paying 1,200, and this difference of 200 is the variable payments. Okay, it's supposed to be included in the lease liability. Okay, and if there is any expected residual value guaranteed, okay, so expected residual value guaranteed, okay, is supposed to be added. The expected residual value guaranteed, maybe at the end of the lease term, maybe the lessee leased the asset for 5 years, okay, for 5 years, and there is an arrangement between the lessor and the lessee that at the end of the lease term, the lessee is going to take over the asset, or is going to buy the asset. Okay, so if they expect that the lessee will buy the asset for 2,000 Ghana cedis, okay, at the end of the lease term, and this should be the expected residual value guaranteed. Is that okay? So it's supposed to be included. Okay, and if there is any penalty for termination, it's supposed to be included. Okay, so let's say that the lessor knows that at the end of the 5 years, maybe each year is 1,000, so he's going to get about 5,000 Ghana cedis, and in the middle of the contract, the lessee terminates the contract. Okay, if that can be measurable, the lessee has to pay a penalty to the lessor, and it's supposed to be included in the lease liability. Okay, so this forms the lease liability. But remember that when we were listing the component of right of use asset, there are so many components. So let's assume that all those components are not available. Okay, those initial direct costs incurred and all those stuffs are not available. It means that the lease liability is supposed to be the right of use asset. Okay, so in some questions, the lease liability will be given to you straightforward. Okay, so you are not going to compute for all this. Okay, so maybe in a question they gave you the cost price of the asset being 5,000, so that is the lease liability. You don't go to compute for anything, you just pick the lease liability to begin with your subsequent measurement, where you prepare your amortization schedule to determine your finance cost. Okay, I want you to understand that sometimes in a question there will be no information available for you to calculate your lease liability at the initial recognition. Okay, so in such circumstances, there is a formula for you to adopt to determine or to find your lease liability. Okay, so I want to show you this formula. So lease liability, okay, is equal to the annual lease payment. The annual lease payment multiplied by the annuity factor. Okay, so when there is no information available or there is an annuity factor in the question, what you are going to do is that you multiply the annual lease payment by the annuity factor in order to determine the lease liability. Is that clear? We are multiplying the annual lease payment by the annuity factor because the lease or lessees apply the annuity concept in making their payment. Okay, because their payment is made periodically. Because the payment is being done periodically, we adopt the annuity factor in order to determine the lease liability. Okay, so you multiply the annual lease payment by the annuity factor to determine the lease liability. Okay, sometimes the annuity factor self will not be provided in the question. Okay, so you have to find the annuity factor yourself. So there is a formula to determine the annuity factor. Okay, so annuity factor annuity factor is equal to 1 minus into bracket 1 plus R minus N all over R. Okay, so we are going to use this formula to determine our annuity factor when it is not given in the question. Then we multiply it by the annual lease payment to determine our lease liability. Okay, and this R over here, or this R you can see in the formula, is the interest rate implicit in the lease. Okay, so if the interest rate implicit in the lease is maybe 13.7%, okay, it means that this 13.7% will be substituted into the formula where there is R. Is that clear? And the N here is the number of payment period remaining. Okay, so if the lease term is for 4 years, okay, and payment is being made in arrears, it means that payment will be made at the end of every year for 4 good years. Is that okay? It means that the number of payment period remaining is 4. That is N is equal to 4. Is that clear? But if the lease term is for 4 years and payment is being made in advance, it means that payment is made at the start of the period. It means the number of period payments remaining will be 3, because 1 has already been made at the beginning of the financial year. That is, payment has been made in advance. In that circumstances, N is equal to 3. Is that clear? So you can use this information to determine your annuity factor. Then you fix it, the annuity factor, into this to determine your lease liability. So we are done with the initial recognition. Okay, so we are going to look at subsequent measurement. So in subsequent measurement, the lessee has to measure the right of use asset, okay, in order to depreciate the asset. Okay, so the lessee may decide to do that by choosing maybe the cost model, that is IAS 16, okay, or you can choose to do that by applying the fair value model, okay, that is IAS 40, and that can also be done by maybe applying the revaluation model, that is the same IAS 16. Good. So in an attempt to depreciate the asset, the lessee can adopt to apply any of this model. Is that okay? So when the value of the asset at the commencement date is maybe 5,000, okay, 5,000 cedis, and the lease term is 5 years, okay, what is going to happen is that in depreciating the asset using the cost model, we are going, because it is for 5, the lease term is 5 years, we divide it by 5, and it is going to be 1,000 for each year. Okay, that is the depreciable value. Is that clear? But remember that the depreciation charge, which is the 1,000, okay, it is going to be charged to the statement of profit or loss, okay, as depreciation charge, and also the interest expense will be charged against the statement of profit or loss. Is that clear? And also at the commencement date, the lessee shall measure the lease liability by increasing the carrying amount to reflect the interest on the lease liability. Is that okay? And also he has to recognize the lease liability by reducing the carrying amount in order to reflect the lease payment made. Basically, we have about 3 methods of calculating finance charge. So let's look at the methods. Is that clear? So methods of calculating a finance charge. Okay, so 1, you have the straight line method. Under the straight line method, okay, in order to determine the finance charge per year, what is going to happen is that, so finance charge for the year, okay, that is the total finance cost total finance cost. Total finance cost of the lease term over the number of period. Okay, so number of period. So the total finance cost over the number of period will give us the finance charge per period. Okay, it means that the finance charge will be equal because it is a straight line method. It will be the same throughout the entire lease term. Okay, if the lease term is 5 years, it means each year, if the finance charge is, let's say, 2,000 cedis. Okay, it means that for every year the finance charge is going to be 2,000 Ghana cedis. Okay, and the second method I would like to talk about is the actuarial method. Okay, so the actuarial method. Okay, so with the actuarial method, this method is highly accepted by the IAS standard. Is that okay? In determining the finance charge, what happens is that a constant interest rate, or the interest rate implicit in the lease, it is constant. So it is going to be applied on the lease liability, the outstanding lease liability. Is that okay? So if the interest rate implicit in the rate is maybe 6%, okay, it means that every year 6% will be applied on the outstanding lease liability. Okay, so this model is highly accepted by the IAS standard, and in our calculation, that is what we are going to see, or that is what we will be using. Okay, in most questions they will give you the interest rate implicit in the lease. Okay, so you are going to use the actuarial method to prepare your amortization schedule. And the third method I would like to talk about is the sum of years digit method. Okay, so that is sum of years digit method. This method is widely called the rule of 78. So rule of 78. Okay, under this model, the digit is rearranged in reverse order. Is that okay? With an intention that a higher interest or a higher finance charge is attributed to the first period where the outstanding liability is high. So let's assume that the lease term, or the number of period is 3 years. Is that okay? So first year, second year, third year. Okay, so the sum of digit to be 1 plus 2 plus 3. That is going to give us 6. Okay, so in our rearranging this to ensure that the first year, okay, so this is the years. Okay, so the first year receive the higher finance charge. What is going to happen is that we are going to reverse it. Okay, so reverse it, the 3 will come first. Do you get it? So to determine that it will be 3 out of the total digit, we multiply it by the total finance charge. So if the total finance charge is maybe 6,000, and the second one will be 2 out of 6 multiplied by the same 6,000, and then the third one will be 1 out of 6 multiplied by the same 6,000. Okay, you can realize that the first year will receive the higher finance charge as compared to the remaining ones. Okay, so this is all about the methods of calculating the finance charge, but the actuarial method is widely used. Okay, it is highly accepted by the IAS standard. Okay, where there will be interest rate implicit in the lease. So this is the basic knowledge I want you to understand on the IFRS 16 criteria. Is that okay? In our subsequent video, we'll be taking the number of questions and we try to solve it, how the lessee account for his lease payments. Either the payment is being made in advance, that is at the start of the financial year, or in arrears, that is at the close or at the end of the financial year. We are going to take questions on that and try to solve to enhance our understanding. Is that okay? So you just subscribe to the channel, turn on the notification bell so that when I begin releasing those videos, you will get notified. Until we meet, I think bye for now.